Everybody, welcome to the third online forum of the Media Expert. My name is Mauro Gasparotti and I'm the director of Savills Hotel. Savills Hotel is a separate division of Savills Group specializing in hospitality, asset management, consultancy, and brokerage. As usual in our series, we'll be talking about recovery. In the first forum, we discussed a bit on the market performance of the different countries, focusing very much into Vietnam and Thailand on the reopening and the forecast. Last week, we tried to bring in international territory to see their support into the recovery, and if the AGMA is holding on this period. So this week, we'll be digging into a very interesting topic, which is great interest of a lot of people, not just the hospitality people, but really open up to all the real estate industry. We'll be talking about the future of hotel and asset valuation. Now, it's probably too early to start really to understand the situation we're getting into, but at least we will give it a good try. Let's start by showing you the agenda. In the first part, we'll talk about the Southeast Asia hotel market and investment update. Then we'll move into the asset valuation. We'll discuss what is the new normal and how our panel of expertise see the new valuation and the new investment side. Then we'll move into the distressed asset, talking about the trophy asset and portfolio acquisition. If we have time, then we'll dig into a bit of Q&A session. So let's start with connecting to our set of panelists. Today, we have 4 panelists connecting from Singapore and Thailand. They are all from home, so we'll all hope that the connection will hold. We start with Raymond Clement, Managing Director of Savills Hotel Asia Pacific. Christopher Herr, Chief Investment Officer of Lodgis. Greg Condon, Head of Hotel Valuation for Southeast Asia in Savills, and Jonathan Lynch of Counsel of DLA Piper. So we'll start with everybody joining, and probably the first one I like to bring into the picture is Raymond. Raymond, are you with us?
I am, Mauro. Thanks for the invitation today to come and speak with you.
Okay, can you open the video? We don't see you on video. Okay, excellent. Ray from home. So how are you? And how are you doing?
I'm very well, Mauro. How are you?
Good. We're still in the office, so a bit more safe. As you know, Vietnam is back and recover and start to travel. Okay, I'd like to start with you because you somehow are in contact with all our office, and of course you cover all these different countries. So if you can just give us an overview of the country you are touching into in Southeast Asia, but we also like to know a bit into Europe and Australia, since you are in constant connection with our office over there. How is the market look like?
I just wanted to quickly say thank you for the opportunity to come and speak today. We have a good group of panelists today, and I think there should be some highlights of information that come through. Primarily, I'll focus on the Southeast Asian region, but for the last, what is now probably 7 or 8 weeks of lockdown, it's been an opportunity to speak a little bit broader to our European clients, our UK clients, and our Americas to try to get kind of a full picture of what we're going to see in the next 12 to 18 months. You know, going in pre-COVID, we were on quite a high in 2019, both from a leisure and a business perspective. We saw continued growth in the outbound tourism from China, which generated very large opportunities for revenue streams. We had a strong expectation for the year for robust momentum in the MICE network, especially with the Singapore Air Show and the Tokyo Olympics. Investors saw this activity in 2019 and transacted on it, creating the highest recorded full year in APAC, with just over 13 billion worth of hotels sold in 2019. And this basically showed a 50% year-on-year from 18 growth, which is obviously exceptional. In 2019, throughout Asia Pacific, the investors that were active were from all major geographies, particularly private equity, institutional, and some high net worth. Therefore, 2020, our predictions going into the year were very strong. we saw a lot of the same considerations. Obviously, there was the possibility of some economic or political headwinds, but potentially influencing how investors were going to underwrite some of these deals. But for the most part, our expectation going forward was very bullish. And then COVID hit, changing not only our industry, but probably the world over for the foreseeable future, if not for forever. In the early terms, what we've looked at is mainly for owners looking to their debt markets for some assistance. So far, the banks have been supportive in extending waiving of breaches in any covenants and flexibility in interest and capital repayments. But as the pressure in the system will build or has built, the arrangements may change for some of the less well-capitalized hotels, and the banks themselves might start coming under pressure, and that's where we'll see a major shift in market sentiment. So currently, what we've seen over the last 6 to 8 to 10 weeks, especially here in Singapore and Southeast Asia, is relatively a lockdown. So we've seen a majority of the hotels just closed or used for medical purposes as a kind of a hospice to the people who are not sick, but yet not in the clear of having yet been tested or being tested for COVID. So for here in Singapore, it's been a very quiet 2 months. We are coming out of it now. We have just relaxed a few of the lockdown measures, and the plan is to be back in the office by June 1st. The heartbeat is right now is just survival mode. So right now we're not seeing any sellers come to market. We're not seeing any opportunities. We're not really being tapped on by the private equity or the institutional guys saying, what's out there in distress. So right now what we're doing is just collecting as much intel and understanding of where the markets are going. And so far, it's catastrophic. I mean, we've never seen anything like this in the history of the industry. I think the reactions so far by especially some of the major operators is to be commended. I think they've done everything they possibly can to relieve some of the financial stress put on independent owners. Obviously, from institutional capital around the world, where there is very large exposure to hotels, not only in Asia, but abroad in Europe, the UK, and the US. These guys have a decent bucket of liquidity to see out the major part of the storm. It just depends on how long this storm is going to last. So, I mean, that's kind of a recap of where we were in 2019, how we headed into 2020. As you mentioned, it's a bit too early to really talk about independent deals that are happening, but we certainly see that markets like Vietnam, we see markets like China, Korea, Japan, they should rebound relatively quickly after the virus has been contained, and this is mainly due to a domestic demand that's put onto the market. So we will see a lot of domestic travel. We've already seen witness of that in China. China recorded, I can't be exact on the figures, but over $6 billion worth of revenue in the hospitality market over a 3-day span. Vietnam has done a phenomenal job at going through this pandemic and keeping it relatively under control, keeping its people and its population calm. And its response has been one that should be copied or should have been copied around the world. And therefore, next week, domestic flights reopen. Those domestic flights have already been relatively booked out. We've seen coupons from hotels that have allowed for basically a kind of a 50% waive on cost of the hotel to come anytime within the next 365 days. So we expect a lot of people to do some weekend travel in Vietnam to the island resorts, which will obviously create a good rebound in those particular markets. We see corporate centers within Vietnam, Hanoi, Ho Chi Minh, Da Nang, a few other second to third tier cities probably restarting their corporate markets, so people starting to travel for work. Japan obviously is still going through its lockdown period, but we see the rebound in Japan and Korea being similar because of their domestic demand, and especially China. I think China will lead the way. Markets like Australia are reopening. Australia obviously sits outside of our framework here in Southeast Asia, but it's a good kind of picture to look at. They took a little bit more of a relaxed approach initially, and then locked down for a number of weeks, and now are slowly coming out of it. Singapore and Thailand are quickly following, and then you have city-states like Hong Kong, which are slowly showing rebounds. But hotels and operators, I think owners and operators have worked relatively well together and to come up with some interesting ways of trying to drive revenue, whether it's taking deposits on these coupons to which you can use from a year that basically allow you for a weekend getaway to a local resort that you normally probably wouldn't have traveled to. My concern where the distress will lie is certainly the family businesses, where the cash flow side of the business was their income. And when that dries up, which it likely has, the asset will be the only retaining of value that they can see. So that will be where the distress lies. But that will be a very entrenched kind of local family to family business or dealings in places like Thailand, Indonesia, mainly Bali, and the island states there, Malaysia. But I do believe that we will see in Southeast Asia a lot more opportunity. And I think there'll be, and Greg will probably speak to this better than I can, but there'll be more towards valuation markers with the premium kind of wiped out. So we won't be looking at adding 20% premium to it. We'll be just trying to get the properties on market and to an investor at a valuation that is on par. The question is also who's buying. The debt markets are going to freeze up, that's for sure. Banks are going to be very hesitant to continue lending on, especially senior financing, on any major projects around the region. And this will include Japan, Australia, China. So I think the real hurdle will be how much dry powder do you have, and really how much of a discount do you think you're getting for that dry powder. So I think if you're an institutional fund or you're a private equity with a large investment side that you have to report to, generally speaking, the structuring is how you're going to get a deal done. And without the senior financing or mezz debt really available at competitive rates, I think people will find it very difficult. The high net worths, like they did during the GFC, will probably be the ones who come in that are able to extend full capital raise for the acquisition. So basically deliver cash on demand. And that will be what secures these deals at a discount at a very quick pace. So we do see that Q3 will be kind of a wait and see as Q1 and Q2 have been. So Q3 will be a little bit of letting out the breath and just trying to see where the positions are. And then Q4, I think, is where we start seeing the harpoons, and then the people with that dry powder really put some muscle into trying to get a few deals done. Obviously, 2020 will be on record as probably one of the lowest transaction years we've seen in our industry. But really, the most important thing is that we've come out of this. We've come through this situation. Obviously, everyone hopefully still being healthy and kind of having reconfigured what really lies into the importance of what we do. So for my part, working with our broader team with George Nicholas in the UK and his European team, the distress there is kind of a few weeks off of where Asia is. So we're able to give them some insight of where we're going, where we've been, and they can kind of collaborate, and we collaborate a little bit more about how we can support our clients. So we've been doing a number of these events. Similar, we've been doing very much one-on-one with our clients to give them an APAC, a European, Middle East, and North American point of view, because they're all different. The last thing I do want to say is that from when we've seen the markets dip like this, starting with obviously the Asian financial crisis all the way through to September 11th, and then we saw the GFC hit. I think the biggest difference that we're facing now is that during those times of distress, the globe, from a political standpoint and an environmental and government standpoint, came together and really worked closely together to come up with definitive answers of, let's just use the GFC, just how can we save the financial system from actually melting down, not just in America, but globally. I think the difference of COVID is that it's been a very kind of individualistic view of how we deal with the problem. So each government has dealt with it differently. They're going to deal with it differently. Singapore is either going to, Singapore might restrict outbound or inbound flights for the remaining of the year. You never know. Where Vietnam might say, come one, come all. And that will really be the difference of the size of the rebound. So without a conservative global approach to this rebound, it's gonna really rely on a country by country, state by state basis. So it'll be interesting, but you'll have to pick your spots carefully.
Thank you, Ray. There was next time we'll do just a conference with you as a sole speaker. You'll seem taking a lot of topic, and you give a very good base for the other speaker.
I'll leave it to the specialist now that will actually speak a lot more sense than I will. Thank you, Mauro.
Good. Let's you'll come back soon. I like to connect with Chris if you are there. If the technology doesn't let us now, Chris, how are you?
I'm doing well. Can you hear me okay?
Yes, we hear you okay. I think Ray gave you a lot of rope there to just grab and start to give your point of view into a bit of overview what's going on here, and maybe also mention specifically the country where you guys are having an active business.
Yeah, Ray tends to steal my thunder, but I'll it's okay. So I'll just on the question of overview of the markets, I'll just touch on Lodgis to kind of frame where we're spending most of our time and energies. Piggyback off of some of Ray's apt comments on Vietnam, where most of our assets lie today, and then a quick perspective on kind of where we see things going forward from the standpoint of the markets and managing our business. First off, Lodgis was formed at the end of 2016 by a partnership between Warburg Pincus and Vina Capital. Today, we've accumulated about $1 billion worth of assets, 90% of which sit in Vietnam, and the remaining 10% or so in Cambodia by way of the 2 Raffles hotels we acquired in 2017. On top of Vietnam and Cambodia, our target markets are Thailand, Indonesia, Maldives, Myanmar, kind of Indo-China, Southeast Asia broadly put. Today, our portfolio has 18 assets/projects under ownership, 10 of which we own outright, 4 of those 10 under development, and then we have 8 management contracts that we operate for third-party folks. Today, as we speak, unfortunately, but certainly not alone in this, is half of our portfolio, roughly speaking, are closed. We are monitoring the situation as best as we can and very real time. We did have a few of our properties closed, and then we've reopened them up, like Phu Quoc. The Nang properties remain closed, as does Clement. We are hopeful and targeting that we'll open those up, call it June or July, as the domestic market probably starts to return. And overall, we try to feel like we have a pretty high quality portfolio and have an institutional kind of quality management team. But that being said, and as I shared with you, Mauro, the other week, we kind of have a few things that we're focusing on right now. It's capital preservation, protect the balance sheet as much as possible, manage our operating costs and overhead, both at the asset level as well as at the corporate, and then just stabilize our portfolio, meaning just really try to create enough, try to retain as much value as you can in the assets, keep our development projects going. But again, going back to the first and second point about managing capital and the cost structure, we always have to keep that in mind right now. So it's not surprising to hear from Ray, who's talking to a wide body of investors, some folks like us, that right now a lot of folks' number one priority isn't necessarily deployment, because I think as we're going to talk about through the course of today, there's a lot of things and a lot of headwinds for people to reconcile and understand. In terms of Vietnam, listen, again, Ray mentioned a lot of these things, great containment and management of the virus in general, 10% of what Thailand has recorded in terms of cases. So Vietnam is just under 300, Thailand is over 3,000, and it's obviously faring a lot better than Singapore and some of these other more developed markets. So great on that note. So the government really has done a solid job. And I think, again, it is a testament to the people there that they really buckled down and are able to take government measures quite seriously. So that all bodes quite well. Vietnam, as folks know, has a great sizable domestic market, which we think we should benefit from. One of our assets is the Grand Ho Tram, and that's a kind of a great example, I think, of a drive-to asset of scale that can offer a lot to the local Ho Chi Minh City and around areas. So that asset has done quite well. I think in closing on this part, looking forward, the picture is obviously, to say the least, complicated, right? There's some slight lime-colored shoots, as they say. I don't know if they're fully green yet, but there are obviously a ton of headwinds and a lot of uncertainty. So again, we're really hunkering down and again managing the balance sheet and our operating cost structure as much as possible. We don't think that international travel is going to come back in any kind of meaningful way, maybe until really at the end of this year, Q3 at best, but more likely kind of a Q4, first half of next year kind of event. So therefore the portfolio, our expectation in the way we're trying to manage our business, because it's hard to obviously manage anything really from a day-to-day, but from a budgeting standpoint and trying to plan our resources, is that the rest of this year will be kind of improving, but very intermittently. And again, managing the costs as best as possible. And then just kind of seeing how things kind of play out. But again, not making any aggressive decisions from either a operating standpoint or from a capital deployment standpoint.
Yes, thank you. I mean, it was interesting what Ray mentioned, this wait and see approach, where it seemed that the transaction, of course, this year will be lower, but people are waiting. What's your opinion? Are you also guys into a wait and see mode?
Yeah, now listen, there's, I think that's right. In simply put, as I was saying, we're kind of focusing on what we have versus trying to chase more stuff to put into our business. That being said, listen, we're opportunistic investors at our core, and there's stuff that comes through every day really about kind of different things here and there. But I think we are waiting and seeing. I think we'll talk about through the course of today asset valuations and distressed opportunities. I think those are all factoring in our view that we'll certainly take a wait and see approach. The buy sell gap is still quite large. I think folks who are owners still remember what it was like 6-8 weeks ago. But the folks that are looking to buy, they're looking, obviously in the future. And so I think that's going to take some time to really work itself through. So we're fine. We're being patient. And, we'll again talk about this a little bit more later, but I feel like there will be some interesting opportunities coming out as this thing kind of unfortunately continues on.
Thank you, Chris. And yes, as you correctly state, later on we'll dig a bit more into this situation and opportunity that will come. Maybe I'd like to connect now with Greg, if he's still with us. We had a bit of IT problem at the beginning with him. Hopefully it's all well connected, because we've really been talking about Vietnam, but we love to have a Thai opinion and what's going on in the market. Greg, are you with us? Can you connect? Okay, I think we still are handling the situation. So, Jonathan, you need to come and save us from this situation. Excellent. Thank you, Jonathan. Ready to go. How are you? And how are you doing? Still home?
I'm doing well. Can you hear me?
Yes.
Okay. Bear with me. Hopefully the connection holds.
Good. So we've been talking about a lot of info from Ray, from Chris, really a lot of a different point of view. We'd like to know from your side, so from a legal side, do you see any trends coming up? Do you see changing something from the M&A point of view? Do you see people looking into a new way to do deal or any new terms that has been proposed?
Sure. From an M&A standpoint, broadly speaking, across all sectors, real estate, telecom, finance, consumer goods, it's quite slow. I think that Chris hit the nail on the head. When groups, they can either be offensive or defensive, and most of our clients right now are taking a more defensive position, not just to see how things unfold over Q2, Q3, Q4. We do expect, in talking to our clients, an uptick in transactions from Q4 and then coming into the new year. The reason is that, as Ray and Chris mentioned, there's a lot of dry powder out on the market. Statistics say across all funds, uncalled capital globally is in the trillions, and that's quite a lot of money. And right now, it's just sitting on the sidelines waiting to get deployed. When that is, it's kind of wait and see approach. But when it does get deployed, this is the 100-year storm, and for PEs, this is potentially the 100-year opportunity. So a lot of that money, we feel, will be allocated into the hotel sector. As Ray mentioned, he talked about the equity side of things and also the private lending, the debt side of things, whether it's a distressed debt play, whether it's extending lines of credit, mezz financing. That'll be one avenue that the PEs will be taking, we feel. But if you're an owner sitting out there, and especially owners in some of the emerging markets, the ask, and it's not going to be cheap cash. So owners, if they have liquidity issues, are going to be looking for any type of avenue in order for liquidity, in order to stabilize their operations. One thing that we think is going to happen is there's going to be a few more JV transactions. We've already seen an uptick in that in the years prior, and we think going forward, that's going to be even more so the case, especially if you are an owner-operator or more of a regional owner-operator and you're trying to get your flag, one of your first flags into Southeast Asia. We think that by capital injections in the way of equity into either an existing project or potentially a new development that's going to take 3 or 4 years to build anyway, and able to provide some sort of construction financing for that development is one avenue and something that we're looking out for. And then the operator is able to either rebrand the property or able to get one of its first flags. And we think that's especially going to be true in some of the more resort destinations here in Southeast Asia. Something else to keep an eye on, we're talking about Southeast Asia, is I think that Southeast Asia, some of the regimes here can be quite protectionist in their laws. And we know that we feel that there's going to be a flight to safety for a lot of the institutional lenders that are going to go to some of the more core markets. Ray mentioned Japan, Hong Kong, Singapore. So the question is, how are countries like Vietnam or some of the other emerging markets going to attract foreign investment? And I think, in talking to some people, some high-level people, we think that there might be some relaxation on some of the ownership restrictions, whether it deals with land or making it a little bit more easier to repatriate capital out of the country, maybe some tax incentives, because in situations like this, it's typically the poorer countries that hurt the most. And so it would be very interesting to see what government actions are taken in order to draw in some of the foreign investment. And then, of course, on the M&A side of things, there's going to be winners and losers. And another trend is, and we've already seen this in years prior, is a little bit more operator consolidation. Hopefully, I think that as Ray hit the nail on the head, and he said, it's about survival and it's about protecting what you have. And hopefully all the operators make it out of this, but some of them might not. So it'll be interesting to see which ones don't. We think that the ones that own and operate, that are a little bit more diversified in their holdings and not strictly in hotels, but are a little bit more diverse, data centers, logistics, those are doing quite well right now. So I think those type of groups are the ones that might be able to weather the storm a little bit better. And so that's more or less how we see things playing out in the next year or so on the M&A front.
Thank you, Gianluca. Ray, do you like to add something since Ray, your microphone is off.
I said I just wanted to concur wholeheartedly with all that conversation, but particularly the last part. I think we're going to see a plethora of opportunity for some of our larger hotel operators, whether they're IHG, Marriott, or Accor, continue to look at some of the smaller, more localized branding and take up these operators as a JV or merger of some sort. If these operators, as Jonathan said, are asset heavy, that will make it more compelling, to where we will likely see those operators then push the asset portion of it out the other end back into the market. So we'll see opportunity come directly from the operators to eject the actual physical ownership of the real estate, but to keep the new flag. So that's a very good comment that was made. The other part is debt advisory. I think able to advise our clients on especially the ones that are having cash flow crunches, and being able to provide lines of credit. So speaking with PE firms and then understanding that maybe at the moment the real estate side is kind of out of the rearview mirror, but with regards to extending some lines of credit to be helpful to some of the owners in the region and gain access to these potential acquisitions. We've seen a lot of that interest starting to align to the market. So that was it.
Thank you, Ray. Connecting to Jonathan, I think he's connecting. Yes, Ray, please stay. I don't know if I scare anybody. Every time I open the mouth, somebody says, stay, don't worry. And see all of three of you, we got the technology. Jonathan, I'd like to touch with you on some of the points you made. Which country would you see coming out a bit better out of this situation, if we can call it actually better? Which country are you guys more active, or where your client now will be looking at out of all this conversation?
I think it really depends on what client we're talking about. We think that urban investment is going to trail some of the resort investments. So if we just had to call it on the jurisdictions, we think that Thailand's going to suffer quite a bit. We think that Vietnam is a little bit better positioned than Thailand is. I think that Indonesia is going to have some difficult times ahead as well. Singapore, Vietnam, those are the two jurisdictions in Southeast Asia that we see the most significant uptick in the short term.
Thank you, Jonathan. We still have a bit of a problem to connect to Greg. We'll try to speak later. Maybe we'll have him joining at a later stage of the game. So Raymond, I'll pass it directly to you, and then later we'll move to Chris.
Sure.
In asset valuation, I know you touched it already, but generally speaking, do you see a drop into value, or do you see people that will go after bargain, or do you see the value holding because of this short-term situation, or they will be completely changed?
No, I think the comment where people still remember 8 weeks ago is one of the better comments that's been made on this. Is the owners still remember the heyday. That hasn't dried up, and quite frankly, the performance of these hotels in and around the region for much of all of, if not all of Asia, has been very robust for the past decade. I mean, we've seen growth. We've seen growth on double digits nearly every single year. The tourism for Vietnam has increased, significantly. Japan went from 9 million to nearly 40 million, or 30 odd million. I mean, we've seen a major increase in tourism, a major increase in spending, and the capital flows going into these hotels were significant. So no, I don't see the valuation metrics having changed dramatically. I guess there's 2 points I will quickly add. My question will be, where do you add in the risk component? Where do you see the yield market going up, and that's kind of what you take as your risk adjustment? Personally, I think it falls much more on the operator side. I think a lot more guarantees and things of that nature will be requested or required during HMA negotiations. If you're already under contract, I think you're basically stuck. But the question is where do you add the risk back into the deal? To go back to your initial question, where do I think there's going to be the best opportunity? I think it's going to be countries like Vietnam, for countries that have a lot of strings to pull. As Jonathan had mentioned, there's a lot of restrictions of trying to have a foreigner acquire an asset of any type in Vietnam. And there's a lot of strings the governments can pull from tax reductions to ownership structures to exporting your capital back to your home country. So I think that the Vietnam government can make this rebound as big as they really want to. And I think there are going to be opportunities that wouldn't have existed because pre-COVID, because of the robustness of the market that will come up in places like Japan, Korea, Hong Kong. I think places like Singapore are pretty stable. And I think Thailand is always an interesting interpretation of where you see value in that particular market. And then I think Australia will show significant signs of opportunity. I'm just going to talk until Greg or someone joins.
It's okay, it's good. Greg will still try to get him, but I'd like to have a Chris opinion into this. Now, we move really in the second part and look into asset value. Pity we don't have Greg here, which she's actually the head of valuation, so really talking through. But Chris, maybe you can add it. We talk about risk, where the risks go, are we looking at yield or are we looking at cash flow? What's your opinion into the future of the value?
Yeah, so to put it very simply, I think near-term valuations will be down. I mean, it's hard to really imagine a scenario where they're going to be equal or higher than. Oh, can you hear me?
Yes, Chris.
Sorry. Yeah, couldn't. No, I was just saying that I think it's hard to see a scenario where valuations will be equal to or higher than they were in 2019 and recently. So, I think when we look at 2019, we're going to look at that for a while to be the last peak. That's going to be a kind of a key reference point for us. And so I think when we talk about valuation, obviously there are a couple of little there's a basic paradigm of income over the cap rate, which we can touch on, but there are a lot of kind of countervailing and factors and things you need to consider. One, again, given where valuations were, cap rates were getting compressed down quite significantly in the hotel asset class. They were kind of getting accepted as an institutional grade investment class, similar to office and retail and residential. And then you had the supply and demand dynamics of these given markets, which I think that whenever you have these kind of shocks, you're gonna oversupply dynamic is only going to be further amplified, right? I'll kind of give you our view, Lodgis's view on kind of where we see valuations. Again, you have to kind of frame it with some kind of a view on whether it's going to be a V, U, W, or whatever letter you want to use, because that kind of embeds it into your kind of corporate model assumptions, right? Again, as I mentioned earlier, we feel like we have a pretty strong portfolio, obviously quite focused on Vietnam, but nonetheless quite a pretty strong portfolio. If you think that income is down somewhere between, I don't know, 5 to 30% based on the market, and then on the cap rate side, it's a function of obviously cost of borrowing, but also the risk premium that investors are having to be compensated for taking that amount of risk. And I think, as we're saying, at least from our perspective and kind of a lot of different, reading and absorbing different information, I think most people's cost of capital is increasing. So, the Fed and everybody else can keep pumping in liquidity to push the debt rate down and debt availability. But the reality from an equity investor perspective, it's a lot harder to model what the future will be, particularly coming off such a big peak. So I think, kind of circling back, Mauro, to answer your question, I think valuations are definitely trended down. It really depends on the market, the asset, the ownership, the brand, everything in terms of what the band will be. But I wouldn't be surprised if if you draw a bigger circle between, if you compound the income going down and the cap rates going up, somewhere between 5 and 30% kind of across the region. And maybe that could apply to the world, but certainly here in Asia, I think that wouldn't be surprising. Then the question, is that temporary and is that a long term? No, I think we're all feeling quite good about the longer term perspective as Asia Pacific. But I think shorter term, coming out of COVID, it's hard to ignore these factors that I'm mentioning.
Thank you, Chris. Again, I think you made a lot of interesting points. So it seems that you look into asset to really give this opinion into value. Some of your assets, which are actually drive-by destination located in Ocheon, they actually could benefit from all of this. And it's also interesting the point that Ray made at the beginning of being creative. It somehow come as a strategic choice of some of the hotels to come with promotion, or come to a new way to actually market themselves and generate revenue. We come back to you, Chris, on this asset value later on. Now I think we're so blessed that Greg finally joined us. I hope the microphone will be okay. Greg, how are you?
Hi there, Mauro. How are you? Can you hear me?
Good. Yes. I'm sweating. That's how I am. But now that you're on board, we're all fine. So thank you very much. Let's start from the initial question that I wanted to ask you, and maybe let's just keep it short as well. How Thailand is doing?
Well, thanks for letting me join. I'm a little bit nervous about being the valuer on the call when times are very interesting for valuers. So, but I'll certainly try my best. It's certainly been a very dark time in Bangkok of late. Literally dark, as I've been able to look out of my condo here in central Bangkok and see a lot of blacked out hotel towers, which is not an ideal situation for the industry. But it's been pretty dire times since the 4th of April, when the last international flights were allowed to arrive. About 75% of all Bangkok hotels are either partially shut down or fully shut down, which is very, very debilitating for the entire industry and the entire city, really. On top of that, Phuket remains completely locked off, completely closed to all visitors. So the industry there is in difficult conditions. And whilst some domestic flights have reopened, you can fly to Chiang Mai, but you will incur a 14-day quarantine upon arrival. So it certainly doesn't make for the perfect holiday destination at the moment. It's more just for local people returning to their homes. Similarly, if I was to drive to Pattaya, I think I'm allowed to stay, but restricted services, closed beaches, nightly curfews, all such things. So it's certainly pretty dire times for the Thailand market. Whilst we're seeing a glimmer of hope, there's been some reopenings of restaurants and some of the markets around the city. We're awaiting a big decision for the malls to perhaps reopen, a decision that should come in a few days. But without the return of the international flights, it's going to be very tricky indeed. The Thai Hoteliers Association is pressing the government to perhaps deal with the 14-day quarantine. If there's a bit more clarity on the containment of the pandemic in the neighbouring countries, perhaps they might be able to relieve some of those stipulations, almost like an Australia-New Zealand situation. But that at this stage, that seems, with the resurfacing of the situation in South Korea, that's making everybody a little bit more nervous again. So we're looking to rely upon the Thai domestic market. That will perhaps come into play in Q3 2020, but that's kind of just the cream on the top. Normally, we need that international arrivals. We need the 40 million arrivals coming in. So, in terms of how business is going to look going forward, I think occupancy rates are going to remain very low across the industry. We're looking at single figures or 15 or 20%. ADR levels we're being told being theoretically held quite stable for now, but there's no competition in the market. The entire market's shut down, and when we start to see a few of the doors start to actually open up and competition come back into the market and re-exist, then we fully expect to see a competitive market flare up, and perhaps ADRs will take some time. So similar to the situation perhaps in Vietnam, hopefully we might see some drive time destination markets start to come back into play. Hua Hin and Pattaya being the strongest for Bangkok, obviously. So if we can get some of that going, then we can perhaps wait on Phuket and Chiang Mai, but obviously they're big mainland China markets. So until we see the return of international flights, it's going to be pretty tough going for the owners and operators in Thailand.
Thank you, Greg. I mean, it's very interesting. You mentioned some of the points, and we mentioned before about the local market, which is definitely helping China, is definitely helping Vietnam. Vietnam, I think something like 80% of the total travels was still domestic. So we are looking at a big market. Just a brief question to you and brief answer. Can Thailand survive just with the local market? And when I mean survive, reaching the 30-35% occupancy, when you start to grab a break-even point, can they survive in the next few months with domestic?
Oh, I think that's gonna be a real real test for the high end operators, for the upper upscale and luxury operators. This is having a massive impact upon the economy as a whole. So whilst there may be fellow Bangkokians that are desperate to get to a beach resort and see something apart from Sukhumvit Road and Saturn Road, going down to the levels of having the local industry and domestic market support, 2,500 baht a night, 3,000 baht a night kind of staycations, if you will, or maybe a bit of state-driven or government-driven activity. It's going to be tough, but 50%, 40% occupancy by year end, I think we'd probably take that at this point.
Thank you, Greg. I still want you there because we need to catch up on actually the second part of the discussion where we are in. You saw Ray and Chris already talking about valuation. We'll be talking about yield, cash flow, asset by asset, long and short term view. What is your opinion into the valuation? And the billion-dollar question that you asked us to ask you in the meeting was, what is your opinion into the asset value in the upcoming months?
Very good, very good. Well, I'll very much try my best. As you say, it's the key question for the entire valuation industry across all sectors, but particularly for the hotel market and the hospitality sector and valuations. This is entirely untested waters and something that we don't really have precedent, where the accommodation sector across the board is also being hit with the impact of the travel industry and the decline in airlines. So whilst we've seen Thailand recover from SARS and from Asian crisis and floods and political incidents. This is and people do love to return to Southeast Asia when they can. They love to come back to Vietnam and Thailand as part of their holiday experience. This is really trying to pick when the return of the market may come is an entirely new factor. But it's perhaps maybe just looking at three key factors when it comes to the valuation side of things. I think there's maybe three kind of key impacts that we should focus on. The first is the marketplace and what's going to be the new normal for your marketplace and your asset. When will the infection rate be dealt with and be dealt with as healthy? Vietnam's looking great, but as we've already seen with a couple of flarings of second waves, whether it be China or South Korea, there's still going to be that element of concern. So we'll see how that plays out. Airlift is going to play, it's the huge driver. So when will airlift return back to normal? Towards the end of the year, perhaps, but under what conditions? And will it, be as accessible as it's been in the past? Will we just be able to make a short-time decision? As we just touched on, in the absence of international, what is the strength of your domestic market? Are you, a short distance from a major city like a Bangkok or a Ho Chi Minh or a Hanoi? Can you be a Pattaya or a Hua Hin or a Dalat? and also looking at your source markets for your particular market. Is it a lot of mainland China? Is there a lot of South Korea? Are you reliant on the long haul from the US and the UK or Europe, which we might not see for another 12 months? You know, on a steady rate of return. So you need to find out if these source markets can be replaced perhaps by more regional markets. So on that basis, I fully expect occupancy rates to fall. There was talk, 6 weeks ago about pent-up demand for travel, and we're all going to, as soon as we can, we're all going to get our credit cards out and head to the nearest beach, whether it be, inside the country or abroad. But I think, the last kind of 4 or 5 weeks, in terms of the state of the economy and the unemployment levels, I think that's really going to change people's priorities, and perhaps an abroad trip sitting on a beach when you're broke is maybe not going to be the priority going forward. So we expect ADR levels to progressively start to drop away, as I mentioned earlier. Once we're back into a competitive situation and there's some doors opened, whilst some of the operators and owners are trying to help each other out and trying to hold firm, they'll be looking for revenue recovery, and pretty much sooner or later the competitive aspect of the industry will come out. So in terms of maybe section 2, hotel operations themselves, this is the fine tuning that I need to do as a valuer. I need to look through your P&Ls and look through exactly how we arrive at our figures. The day-to-day operation of these hotels is going to be quite different post-COVID. We're going to be looking at less staff on site. Might be a benefit, might be a lowering of costs, but we're going to have a higher reliance on key staff members, and there might be more reliance on AT or IT to provide that quality service. So whilst it might be seen as a win for the operators to start with to have less staff, that might still prove to be a costly affair. Cleanliness, as we've touched on, is going to be key. Food and beverage outlets, what's going to be the new normal? Huge dining halls or glitzy rooftop bars. They're going to have service requirements. They're going to have number of seatings per day per session. So that will take quite an impact. And when is the MICE market going to return? When are we going to see exhibitions, conferences, and weddings and such? Whether it's 200 people or 1,000 like we get in Bangkok for a Sukhumvit wedding, that will be very interesting to see when that comes back. And also it's been touched on capex requirements for owners for the new world. We're looking at IT upgrades for the guest rooms. We've been talking about improved cleanliness for new lifts and new lift systems that involve contact, and that probably extends into air conditioning systems to maintain that level of quality. So all those kind of things on a day-to-day P&L basis is where I arrive at my assessment evaluation. That's going to change from the normals that we've been able to rely upon in terms of market parameters for the last few years. And then, as I'll lead it to Ray to talk or lead primarily on the investment side. How is the investment market going to perceive hotels going forward? I think Mauro and I have touched on before. This could be a bit of a reminder to hotel owners and investors that this market can be hit from a number of sides. We've seen, whether it be geopolitical or economic, and now pandemic. So I think there might be a bit of a change in the risk appetite, or a review of the risk appetite for hotel assets going forward. There's going to be some fresh wounds out there in the market, and perhaps not everybody's going to be quite so willing to jump straight back in when we see the tides start to turn. But similar to the financial crisis, perhaps a flight to prime. Those markets that have got historical trends of having good occupancies, perhaps they're a key financial centre with historically strong performance. I'm thinking of Singapore or a Hong Kong, or maybe to a lesser extent Bangkok and the jewel cities in Vietnam. walking away or perhaps taking a much more pessimistic view on the secondary market, but those prime assets, perhaps they won't fall away as much as the general norm. So we'll see how that goes. As I say, it's going to come down to property by property specifics, what's happening in the market, the local market, what's your building like, what are your source markets. So, you know, valuers rely on current market data and you know what we see happening in the market. So hopefully with the likes of Raymond out there and his colleagues, you know, we'll start to see some transitional activity as performance markets start to return. But it's a little bit of the chicken and the egg that we've discussed before. We need that performance to start to come back to see where we are. But you know, there'll be opportunistic groups, as Ray said. There's capital out there. There'll be opportunistic groups. There'll be high net worths. There'll be family wealth. It's just those institutional guys that might just have a bit of a review and a bit of a sit back and see how it plays out. So in general terms, you know, we expect overall yields to start to soften a little bit in most markets until the situation becomes clearer. But at the same time, there'll be those lights, those glimmers of light of markets that will hold quite firm as the long-term owners and investors. They know long-term they're onto a good thing, and they'll try to ride it out as a long-term hold. So it's a case of know your asset, know your property, and try to advise as realistically as we can.
Thank you, Greg. Thank you very much. Stay there, don't move away. I'd like to ask Jonathan to connect. And Greg, a last very quick things. You touched on risk and cap rate. Do you believe your hospitality will be perceived as more risky than before as industry, and therefore impact on cap rate, on yield, and everything? So, Greg, your very quick answer into that before I move to Jonathan.
If you could go to Jonathan first, I'll pick up.
Okay. Yes, I will pick up. We still have a bit of connection. Jonathan, to you, I like it to take it from the legal point of view of the valuation itself. Now, what is happening? We saw it before. You may be involved in transaction which started pre-COVID, so 2019, and almost closed, but not yet. So yeah. We have a lot of buyers and sellers coming back to the table and we discussing terms. What do you see?
Yeah, no, it's a very
negotiation. What do you see changing? Please.
It's a good point, and it's something that we are dealing with in a couple of transactions. And it brings me up to, you know, when you buy a car and you drive it off the lot, it typically loses 50% of its value. Well, in our situation, the buyer hasn't even gotten title to its hotel, and it's already losing a lot of its value before it even has it. So from a buyer's perspective, buyers are typically looking for any leverage that they have to renegotiate the terms or potentially to terminate because the valuation it's taking such a haircut. From a seller, they want to hold the feet of the buyer to the fire and to try to close as quickly as possible. So say that, you know, if we had 4 months between execution and closing, well, a lot can happen during that time, and as we've seen in some of our transactions. Buyer, it's always going to be governed by the four corners of the contract, first of all. So typically the first thing that a buyer would look at is the MAC clause, the material adverse change. And a buyer would argue, you know, there's been a material adverse change to the target, whether it's the asset or the SPV holding the target, such that the buyer is allowed to terminate the contract. Now, typically MAC clauses are drafted and they're very target specific. Now, what's going on right now is more industry specific. So in most cases, we find that the buyers are not able to use COVID to trigger a MAC termination. So then the buyer is typically looking at other clauses in the agreement, conditions to closing, you know, whether it's inability to perform a due diligence, it's inability to perform a financing. Those might give it a right to terminate an agreement, or at least give it leverage to renegotiate the terms. Sellers, on the other hand, want to make sure that they lock in those pre-COVID prices. From a seller's perspective, the risk is, you know, the interim operating covenants between the time of execution and closing, that the seller would have an obligation to continue to operate the business under the status quo when we're finding out that that might not necessarily be possible. It might have to incur more debt, might have to lay off employees. So these things might cause a seller to be in breach of the agreement, whether that gives a termination right or simply a right to damages on behalf of the buyer. Really, again, depends on the terms of the agreement. Another issue and a risk for sellers is bringing down some of those warranties and representations at the time of execution of the SPA. Seller is going to make certain representations about the property, and it's going to have to confirm the accuracy of those reps and warranties upon closing, business continuity, counterparty risk, these type of issues. Oftentimes now, sellers are going to be in breach at the time of closing. Again, is that a termination right or simply a right to damages, a right of indemnification from the buyer? It's probably going to be the latter in most cases. So I think that every contract is going to be a little bit different, but as Greg mentioned, no one really could have ever anticipated COVID 4 or 5 months ago. So most contract drafting itself doesn't. But at the same time, so what do the parties do? Do the parties really want to dispute it? Do they really want to go, if the dispute calls for the courts, do they really want to go through the court system, knowing that most courts right now aren't even open, and when they do open, there's going to be such a backlog. So in practice, what we are seeing is that parties are actually working together and giving extensions, whether it's 3 months, 4 months. Most sellers realize you can't get blood from stone. So if people don't have financing, then they can't close on the transaction. So it's something that everybody's trying to work out. And just like kind of in the owner-operator relationship, as Ray said, parties are working together. We're finding the same holds true on the transaction front. How long? Well, we'll have to wait and see. It's still early days in the whole crisis.
Thank you, Jonathan. It was very interesting. Maybe I'd like to connect to Chris, if he's still with us and still alive, to just pass from what Jonathan was saying to you guys. And I don't know how much you can actually disclose, but it'll be very interesting to know if you have started, or if you see any negotiation starting last year that then somehow it's changing now in terms of terms or value or anything, or if you guys actually were doing anything like this.
We are probably in two lanes or two types. One is existing commitments that we have either by way of project contracts or leases, so things that we're already formally locked into. And then we were and are working on a couple of investments / transactions during this time period. Listen, I think Jonathan is exactly right that our general approach, given COVID, has not been to quickly call on the MAC clause or these other legal rights, because that's obviously highly unproductive. In many of our situations, unless it's a pure buy-sell, which we had one ongoing, we've kind of put that on hold, actually. Both parties agreed to put it on hold. For all of these other things, it's really a long-term relationship, right? So to go in there into the boxing ring and try to squeeze each other really is not being the right approach, is how we feel. So yes, we've had to deal with this in different ways. Frankly, again, obviously can't talk about specifics, but I think both sides, the type of folks that we deal with, understand the broader environment and context. At least our philosophy on these things isn't to try to just jam down all the rights that you want or the pricing. You have to be fair, and it's got to be a bit of a give and take. And so, yes, we've had to, and it's opened up the door. It's the fact of it's the reality of the situation. We get direction from our board and our shareholders to say that certain terms and certain things need to be relooked at, and so we just approach it from that fashion, and again, just try to create as much give and take space as possible.
Chris, thank you very much. We are now moving to the last part of the forum, so we'll move into really the discussion into distressed asset, trophy asset, and really looking into the future opportunity. What we had before I connect to all our panelists was a special guest here today, which we just walk next to us and we just somehow grab it, which is Neil MacGregor, is the managing director of Savills Vietnam. If you can join us, join in here. I'd like to ask Neil really briefly into what are the opportunity, the buying opportunity coming here in this country. Doesn't need to be on hospitality, really for the audience, what they will expect to have in terms of opportunity.
I think from a hospitality perspective, first of all, the domestic market in Vietnam had been growing rapidly coming into the COVID crisis over the last couple of years off the back of the rapidly growing middle class, the young demographics, young people wanting to travel more and more, and the rapid growth of the budget airlines in Vietnam as well. So the domestic market for hospitality was very strong in any event. And there will be an increasing focus on that domestic market. And we believe it will gain increased momentum with that focus in Vietnam going forward. And off the back of that, it will also bring into the spotlight new markets, which are within driving distance of the key cities, Ho Chi Minh City and Hanoi, which maybe hadn't been the focus of investors in the past. And there will be new developments in these areas, or perhaps renewed development or renewed focus in those areas that I'm talking about as well. So Ho Cham, within very easy traveling distance of Ho Chi Minh City, a 2-hour drive. Moi Nay, that developed a strong reputation over the last 10 years, but had perhaps been on the back burner a little bit, will be in renewed focus as well. And there's potential for that market to gain new momentum, also being within driving distance of Ho Chi Minh City, and with good new infrastructure connections as well. And markets such as Dalat, not on the beach, in the hills, but a cooler hill station type destination in Vietnam, also within driving distance, but had not perhaps reached its full potential, and that now could be the case. And in the north, maybe Halong gets some additional momentum from the domestic market as well. So I think those, from a hospitality perspective, will be some of the highlights. If I was to pick one sector in Vietnam, aside from hospitality, that would be industrial and manufacturing. And we expect huge interest from investors and continued growth of investment into manufacturing in Vietnam over the next few years. Thank you, Mauro.
Thank you. Stay on, Mauro. I'll try to connect with Ray, but it seems it's struggling to get in, so I will just pass to our team here as well. A quick still question to Neil. Have you already seen interest from investors? Are they already making the call to you to search for something, or it will come in the next week?
So, like I imagine everywhere, people are on the lookout for distressed opportunities. As an agent, we are actively reaching out to the banks. We are addressing that issue and working to come up with quality product to match that growing inquiry for distressed assets.
So you're ready, yeah?
We're ready.
Okay, thank you very much, Neil. This is the uniform that we use usually every day in Savills Vietnam. Thank you very much.
Thank you very much. Thank you for having me.
Thank you. Excellent, just in time. Ray, welcome back.
Mauro.
So, talking about still distress, you mentioned at the very, very initial part of this conference on wait and see. But we would like to know from you your opinion of how long is this wait? Will it come soon, or we need to wait much longer? And which are the countries where somehow will come with a bit more opportunity? You work a lot in Japan. Maybe you can also mention your opinion to that specific market.
I think, I mean, in my definition of distress is more when an owner is pressured to sell when they're not in the appetite of selling. So they need to they're either told by the banks that they have to sell, or they're told by their family members that they need to sell. So I think we'll see different elements of distress across Asia. I mean, I think we'll see it across the globe. We've never gone through anything like this from a global perspective. This is about as catastrophic as it can get. So the distress will come in many different levels, many different places. I don't necessarily think markets that are as core as Japan or Korea will show very much distress. Singapore certainly won't show distress. And that distress, certainly will be alleviated by the fact of the size of the companies that own these hotels. For what we look at, I think this is just going to be, as Chris had said, this is more of an opportunistic market now. There's opportunity that didn't exist before. So, for the right amount of capital and the right asset, there can be a deal to be done. But I don't see there being, as they say, quote unquote, blood in the streets with regards to every hotel we see in, for example, Ho Chi Minh with a for sale sign on it. That's certainly not going to happen. But I think there will be opportunity that will be unlocked that we normally would not have seen had it not been for the downturn that COVID created. We will see some banking and finance issues come through more developed markets like Australia. There certainly will be pressure put on some of the hotel and institutional owners there that are highly leveraged. But I think from the GFC, I think we learned a few valuable lessons, and that was from a structuring perspective, not to over leverage our assets with debt. So I think we've done a relatively good job as a marketplace to keep our debt levels low, our equity in the deals high. So I think if anyone's looking for distress, it's not really here in Asia. Which would lead me into a whole nother conversation to where we can set up a whole nother forum where we're going to be looking at a lot of the Asian capital moving towards the West, going to Europe, the UK, and potentially even the Americas, if they're looking for quote unquote distress. But I'll leave that for now.
Will you also see acquisition of brands keep coming? We all know in the last few years there was a lot of brand acquisition. You see this coming?
Yeah, this will happen more from a domestic perspective. So you'll look at a lot more. If I can give an example of Accor's acquisition of Mantra in Australia, was a very key individual domestic play where it gave Accor a very large platform and a number of different brands to utilize in the Australian New Zealand market. There was never a plan for Accor to expand that into Asia Pacific. There might have been in some markets, but for the most part, it was Accor. We'll see a lot of deals like that. I think we'll see a lot of deals where these globalized operating companies come in and start picking up localized Japanese, Korean, Chinese, very domestic driven, very domestic operated companies and create an additional brand that's a localized brand.
Thank you very much. Chris cannot wait to tell us all about his opinion over distressed and trophy assets. Chris, please tell us what you guys will be up to searching in the upcoming months, if you think there are opportunities coming.
Yeah, I think, to answer that first, I'll kind of give my perspective on some of Ray's thoughts. And I think that he's basically right that, the buzzword of distress, really don't see that coming like we might have seen after the financial crisis or the Asian financial crisis back in the 90s. Really, you kind of have to look at this not as a liquidity-driven issue, right? Lending, I think, as different folks today have been saying, and Ray just mentioned, that was fairly under control. Sure, valuations were getting pretty toppy, but people from a capital structure perspective were being fairly prudent. And then you have the underlying banks that are fairly well capitalized, really all across the world. I can't speak for every corner of the world, but in the US, even in parts of Europe, and then in Asia. So, this is obviously a health crisis driven matter. And so you have the banking system, unlike in 07, 08, actually could be a friend here, not a foe, and be part of the solution. And then, of course, as we all know, we have the central banks throwing, whatever they can into the system to keep it going. That's not to say there are some real structural issues like unemployment, and then some of the things that Greg was touching on in terms of travel being impacted severely, flights and these other things. So, I would again agree that there isn't this kind of huge floodgate that will be opening. That being said, do believe that there will be, if you're kind of patient and wait it out, there will be some opportunities. Near term, we are getting some calls for possible debt investment. I know that was touched on earlier. Not really our main focus, but we would certainly look as a group if it was taking an interesting sliver in the capital stack of either a portfolio or something of scale that we thought would make synergistic sense. Again, we're not pure debt investors. We wouldn't look at it as a pure instrument. We will look at it as a way to get exposure and be part of the table of that particular company. So there are some debt opportunities. I think owners of hotels that were kind of non-core, so they made a ton of money in manufacturing or whatever business, their kind of main business, they made some money in tech or whatever the case may be, but they fell into hotels because it's a sexy asset class. But they realized this thing, they got to keep feeding it. And there's a whole lot of, things to deal with, because it really is at the end of the day an operating business more than a passive real estate investment. So I think there'll be some of those guys. Obviously, as we've been talking about, some of the weaker capitalized folks, whether they're owners or developers, and hotels that were just opened because they haven't been able to mature and get the gestation yet. I think people truly underestimate. None of us here on the phone, video call, underestimate how hard it is to actually get a hotel built and then up and running and stabilized. So even if you did everything right, and you unfortunately opened up in this era, in this period, you're going to have probably some near-term cash flow issues, particularly compounded the fact that if you have some debt on the property, right? So, those will be some themes that we'll be looking at. And then lastly, I think I mentioned earlier, if there will be a flight to quality, just generally speaking, and I think we will be well served by revisiting some of the marquee assets in our region. Don't expect to get 30-40% discounts by any stretch, but if the price difference, if the gap before was 20%, maybe now both sides can come together maybe at 15%, just to make an illustration, because the seller will say, this is time to not waste more time on it. So I think we'll be spending some energies there. And in good markets, like if this was a year ago or any time in 19, really, the conversation would have been a non-starter with some of these owners, or at least maybe you have some opportunity to revisit some of these, high quality assets.
Thank you very much, Chris. Again, a lot of very good points. Is my microphone on? Can you guys hear me? Okay. Yes. So thank you very much, Chris. I think a lot of great points. We are, as every time, running out of time. Otherwise, I really would like to touch a lot of them. What I like to ask Jonathan, still into the distress part. Everybody's talking about distress. People like the idea that those can be bought. But how really is it possible to buy into distressed asset from a legal point of view, especially to cross-border acquisition? You mentioned before that some countries may come with some incentive, but in your opinion, how easy will be the acquisition?
Yeah, so I don't have too much to add into what Ray and Chris were saying. I agree with everything they were saying. The only thing I would add is I think it's really important to know who you're dealing with. Who's in control of the asset? Is it the owner at this stage? And as Ray said, a lot of the sellers probably are going to be family offices. Owning a hotel is a very emotional business, so making sure that everyone within the group is on board with the sale. Sometimes you'll get a call. One family member might say, okay, we're trying to sell this hotel, but you might not have buy-in of all the decision makers within the group. And then, if you're not dealing with the owner who's probably going to try to sell on an as-is, where-is basis, and you're just trying to buy the asset at a discount, then you may be dealing with the lenders. So then the question is, okay, are you buying the note and you're looking to the loan to own, where you're buying and you're going to try to foreclose on the property to the extent you can. Every jurisdiction is going to be different when it comes to that. So I think that's the real important thing to think about is, who's in control of the asset. And when you're dealing, the party you're dealing with might not necessarily have the right to actually sell that property or to give the rights to the loan to you. So that's big, and also understanding, what type of liabilities we're talking about, any type of management fees that might be owed to the manager. Those are going to follow the property. Managers are going to play a fairly significant role, especially the bigger operators out there who aren't really going to be relinquishing any rights and allow, vacant sale of the property, whether it's on a distressed basis or otherwise. So I think those are some of the key issues for parties to think about when they're looking at a distressed property. And as Ray said, distressed has different definitions to different people.
Jonathan, thank you very much, Jonathan. As every time, again, we run out all the period given by the system. We have a good number of questions, but unfortunately we'll not be able to take it. So I'd like to thank everybody here for joining us today. Lot of very different thoughts and very different points that I'm sure will be very useful for everybody. Happy to then put in contact all our panelists to the audience here and anybody that want to know a little bit more about them. So as always, I thank people to attend, our panelists, but also my team, which is here around me, and then you don't see them, but they're actually doing a lot of work through all the seminar. I like maybe just a quick hello to the audience, and then looking forward to see you to the next event. Thank you very much.
Thank you. See you soon.